It's 1 o'clock. I want to go ahead and be mindful of everybody's time. So I want to go ahead and get started again. Welcome to today's presentation. Thank you guys so much for being here. And especially to talk about taxes, which is my favorite thing to talk about, but I know it's not everybody's favorite thing to listen to. So again, thank you guys so much for being here. So we are going to go ahead and get started. But first, I want to tell you guys a little bit about me. Uh-oh. I don't know what just happened there. Okay, sorry about that, y'all. Sorry about that, you guys. My computer freaked out for a second. Story of my life, which is gonna keep on going. My name is Kesha. I am the millennial taxpert. So a lot of people know me as the millennial taxpert. I am an income tax strategist, which means that I help small business owners like yourselves keep more of their hard-earned money in their pockets and out of Uncle Sam's hands. So you guys are doing what you love to do, making money while you're doing it. The last thing you want to do is give it all over to the government. And so what I do in my business is help small business owners keep more of your money and not have to pay so much out in taxes. And I'm working with Collective today to show you guys a couple of strategies that you could use in your business possibly to be able to do that. And then we're also going to talk about some of the things that Collective offers to small business owners like you that does the same thing. I am a CPA, I'm an enrolled agent and a certified tax coach. I might know what a CPA is, not so much an EA and a certified tax coach. All that means is I've done a lot of studying and taken a lot of tests about taxes. And I have become licensed to be able to represent taxpayers in front of the IRS. An EA is a tax expert, certified tax coach is an expert in tax planning and tax strategy. I've been working in the tax industry for over a decade at this point. It's weird to say that, but over 12 years in the industry, probably 13 or 14 now, working with taxpayers of various incomes and needs, starting from people with very low incomes, all the way up to multi-billion-dollar corporations. And again, my main focus is to have people pay less money in taxes. I also do have a podcast called Tax Talk. It's hosted on Apple Podcasts. It's also on YouTube. Some episodes are on YouTube if that's your thing. So you can find me there as well. So that's enough about me. Let's talk about what you guys are here for. So we're going to talk about how S corporations can save money on your tax bill. Now, S corporations are not for everybody. We'll kind of talk about a little bit. We'll talk a little bit about when you might need an S corporation or when it might be beneficial for you. But this is just one strategy and a long list of strategies that you might be able to take care of, or you might be able to utilize in order to, reduce your tax liability. We're going to talk about one of the biggest things that you need to know about when it comes to S corporations, and that's reasonable compensation. And we're going to talk about how to calculate that, as well as some other planning opportunities that you can use in addition to the S corporation to reduce your tax bill even more. And again, any questions that y'all have, we'll answer those at the end. So first, before we get started, let's talk about Collective. Collective was nice enough to have me here to speak with you guys about how you guys can reduce your tax liability. So I want to give them a shout out. First of all, thank you guys for bringing me back. It's always a pleasure to work with y'all. And if you're not familiar with what Collective is, it is the first all-in-one online back office platform designed to help self-employed people. So when you're self-employed, and you guys know this because everybody, if not most of the people here on the, or most of the people, if not everybody here on the call, are probably self-employed. So when you're self-employed, there's so many things that you have to keep track of when your business. It's not just what you do to make money. It's all the back office things that you really don't think about when you start a business. There's the setup of the business, how you want your business to be run, where it should be registered. There's the QuickBooks. There's the taxes. There's the bookkeeping. There's the financial part of it. There's payroll if you have employees. There's retirement and different benefits if you have employees, and even for yourself. There's so many things that go on and when you're running a business, in addition to the actual work that you're doing in the business to generate income and serve your clients and your customers, that a lot of people just don't know about. And when it comes to tax time, all of these pieces have to come together. So when you are sitting down in front of your tax professional, You have to make sure you have your books right. You have to make sure that you have everything in order to pay your taxes. You should have been making estimated taxes. Maybe you want to know what is best for you moving forward so that you're not paying as much money in taxes, in the next few years. And all of that comes to a head usually at tax time. With Collective, all of that gets added into one platform. So it's easier to manage everything, but you have the ability to see everything at once, and you have the ability to get advice on all these different things from one back office. So you don't have to do it yourself, and you don't have to reach out to different people to do it. And then everybody's not talking to each other, and then things are getting confusing. Because one thing that I'd really try to stress with giving advice to clients of mine is that I could tell you what, that you should do this, and that's going to be the best for your tax situation, but you might have somebody else in a different aspect of your business that's going to tell you something that's conflicting because it's better for what they're looking at. All right. So sometimes lawyers and accountants don't always get along because our advice kind of conflicts with each other. So it's really good to have all these things being able to talk to each other so that you're getting the best, the best advice for your business all in one place. All right, so that's Collective. The first thing I want to do before we get into S corporations is ask you, what are you struggling with the most right now? You should see a poll pop up on your screen. So when you see that poll pop up, go ahead and answer that. Let us know what you are struggling with the most right now in your business. This is only going to be up for just a little bit longer. Only choose one option. So if there's a couple of things that you're kind of deciding between, choose the one that's keeping you up at night the most. I know a lot of you want to put everything, but which one is keeping you up at night the most? Just a couple more seconds and we're going to bring it down. All right, I think we are good on that one. Thank y'all so much for participating in that. Now let's get into what you guys are here for, and that is how you can save money on your taxes with an S corporation with your business. So before we talk about like how you can actually save money, let's kind of set the stage for what it looks like when you are self-employed and you are a sole proprietor or a single member LLC. So if you started a business, you are just a sole proprietor, or you've gone and decided to make your business an LLC, that's still taxed the same as a sole proprietor. So from a tax perspective, it doesn't change. And let's say you profited $100,000 in your business in whatever year this is for your business. You're single, you have a personal income tax rate of 22%, you don't have any other income. So as a sole proprietor and a single member LLC, you have to pay your income tax, your self-employment tax, which gives you your total tax liability at the end of the day, right? Your bottom line will be your total tax liability, and that's going to be made up of your income tax and your self-employment tax. When you're an S corporation, it's a little different. You're still going to pay income tax, but instead of self-employment tax, you're going to pay FICA. And that's going to bring you down to your total tax liability. Now, the goal here is to have our FICA be less than our self-employment tax. That's where you're really going to see the tax savings. And we'll talk about how that works in just a minute, okay? So again, big picture, if you have income, if you have a business that's sole proprietor or a single member LLC, you're going to pay income tax and self-employment tax. If you're an S Corp, you're going to pay income tax and FICA. The goal is to get your FICA to be less than your self-employment tax. So keep that in mind as we go through this. How we do that is through this concept called reasonable compensation. Okay, so reasonable compensation is key It's the most important thing to remember for S corporations because it is required that you pay yourself reasonable compensation when you're an S corporation. The goal is to get that reasonable compensation at a peak point to where you're minimizing tax liability, but also meeting your requirements. So what is reasonable compensation? Funnily enough, the IRS doesn't really give us a definition of what reasonable compensation is. What they say is that S corporations have to pay a reasonable compensation to a shareholder employee in return for services provided. So what that means is you are the sole proprietor of the business. You're the only owner, and then you don't have employees. So you're really the one that's generating the income. So if you are a marketing, a brand specialist or a marketing strategist, then you're the one that is dealing with the clients and doing all, coming up with the brand strategies and things like that. You're the one doing that. If you're a photographer, you're the one going out and taking the photos and editing the photos. Maybe you hire some of that stuff out, but you're still doing some work. Even if you do have employees and they do a lot of the work, if you're still managing the business, then you're still, providing services to the business. And so therefore you have to pay yourself a reasonable compensation if you're taking money out of the business. So again, we don't have a strict definition on what it is, but basically what it has come to be is the amount that would ordinarily be paid for the services that you're providing by another organization in the same kind of circumstances. So what would somebody else, or even what would you pay somebody else to do that same job? That's going to be reasonable. So if you could go out and hire a photographer for $500 a month, if there's any photographers on the line, please don't shoot me. Please don't come for me. I don't know what exactly the going rate is. But if you could go hire a photographer for $500 a month, then it might not be reasonable to pay yourself a salary of $1, if that makes sense. Okay. So that's kind of where we're going for with reasonable compensation. Any distributions that you make to yourself as the shareholder employee first has to be categorized as wages. That means that if you're taking money out of the business, then you need to be paying yourself a salary up to a certain point, whatever we determine as your reasonable compensation. And then any additional money that you take out after that can be regular distributions. I am not saying that if you want to take money out of the business, it has to be considered wages. So a lot of people kind of misconstrue that point, and maybe I don't explain it very clearly, but I'm not saying that if you feel like you need to live on $100,000 a year, then that $100,000 has to be salary. We could easily come up with a reasonable compensation of $20,000 or $30,000, depending on the business. And then the other $70,000 would be just regular money that's coming out of business that is not subject to payroll tax. Okay. So don't think that, oh, I can only take, the $20,000 out of the business if they say that's the reasonable compensation. That's not at all what I'm saying. It really just boils down to how are we presenting this on the tax return? What is this looking like on the tax return to determine how much tax I'm paying? You can take all the money out of it. You can leave the, bank account at zero, or, all the IRS cares. It's just a matter of how are we reporting this on the tax return and how are we paying tax on this money? Okay, makes sense? The good thing about it is that reasonable compensation is never going to exceed the amount that you received, whether indirectly or directly. So basically what that means is if you don't take any money out of the business, you don't need to pay yourself a salary. If you only take $100 out of the business, then you only need, your salary can't be more than $100. So a lot of people have kind of these reservations about this because they're like, well, I'm not making any money in my business, so I don't want to have to pay myself a salary when I'm not making any money. The good thing is if you're not pulling money out of the business, you don't have to pay yourself a salary. But once you start pulling money out, the first however much of the income we determine to be reasonable compensation has to be considered wages. The rest of that is distribution. So how does reasonable compensation fit into how we're going to lower our tax liability? I'm glad you asked that question. I have an answer for you. So as an employee, your reasonable salary is now subject to Social Security and Medicare taxes. Okay, so just like some of you may still have W-2 jobs, or some of you may have had them in the past, But just like when you worked a regular W-2 job that wasn't your own company, your salary was subject to Social Security and Medicare taxes, what we affectionately call FICA. And now as an employee of your own business, the salary that you're paying yourself, or the amount that we're considering to be reasonable compensation, is also subject to Social Security and Medicare taxes. This is kind of a way for the IRS to avoid people getting around having to pay into Social Security and Medicare. So FICA, if you weren't aware from your other jobs, FICA is a total of 15.3%. That's 12.4% for Social Security and 2.9% for Medicare. Now, as an employee, you only pay half of that. Your employer pays the other half. But when you are the owner and the employee, you're paying the full amount. So you're paying the total 15.3%. Okay. So in addition to that, when we're going back to just regular self-employment tax is also 15.3% because self-employment tax basically is the self-employed individual's payment into the Social Security system, or FICA system. So self-employment tax is also 12.4% Social Security and 2.9% Medicare, right? So you might be wondering, okay, Kesha, now you've confused me. You said before that we're going to save money on our taxes by switching to an S corporation, possibly. You said that the goal is to have our FICA taxes be less than our self-employment tax, but now you're telling me that FICA and self-employment tax are the same thing. How am I saving money? Again, I'm glad you asked, because I do have an answer for that as well. And the answer is that only your reasonable compensation is subject to FICA. So when you are a self-employed, sole proprietor, single member LLC, tax as a sole proprietor, all of your profit is subject to self-employment tax. Again, we had $100,000 in self-employment tax, or $100,000, in self-employment profit in the example we gave earlier. All of that is going to be subject to the 15.3% self-employment tax. However, when you are paying yourself a salary from your S corporation, only that salary is subject to the 15.3% FICA. So if your profit was 100,000, but we've determined that your reasonable compensation is only 30,000, then only 30,000 is going to be subject to FICA, not 100. The additional amount of your profit is only going to be subject to your regular income tax, is not going to be subject to FICA. That's where the tax savings come from. And that's why I said we want to make sure we get that reasonable compensation number to a sweet spot to where we're minimizing our tax liability. So we want it to be as low as possible, but we also want it to be at a good point to where we're not raising eyebrows at the IRS, right? Nobody wants to raise eyebrows at the IRS. So we don't want it to be too low that it's not reasonable, but we don't want it to be too high that it's cutting into your tax savings. Does that make sense? Please drop a 1 in the chat if that makes sense. Awesome. I love seeing all those 1s. That means I did a good job. All right. So I mentioned before that S corporations are not for everybody. Okay. So I'm not going to be the tax professional that's going to tell everybody to go out and create an S corporation, because they're not for everybody. So here's a couple things that we like to look at, specifically here that Collectives likes to look at to see when somebody should be able to be an S corporation. So first of all, we want to see that you're earning a decent amount of profit. Collective has done the research and determined that $80,000 in annual profit is the key point to where you can actually start really seeing the benefits of having an S corporation. The reason that we want to see a decent amount of profit is because the lower your profit, the less of a tax savings you're going to get. Because if you have $50,000 of, let's just say if you have $30,000 of profit and your reasonable compensation would be $30,000, you're not going to have any tax savings. So we want to see that you have a decent amount of profit. And then there are some additional costs involved in having an S corporation. There's an additional tax return that has to be filed. There's, advisors and stuff that you might need to pay. So you want to make sure that you're earning enough money to where your tax savings are not completely, eliminated by any additional costs. We want to make sure that you have the cash flow to run payroll, because again, you do have to pay yourself a salary. So we want to make sure that you have the cash flow to be able to do that. If anybody's been in business for more than a year, you might have seen the fact that, your bank balance is zero at the end of the year, but you actually do have a profit because of some of the way that things, the way that things go. So we want to not only see that you have a profit, but that you actually also have the cash flow. And then we want to make sure that you're all in, you're ready to go all in with your business, including listening to your advisors and doing what we ask you to do, so that you're not, you're not blowing your tax savings here. All right. So now that we got that, let's talk about the importance of getting this number right, because I've said that there's really not a definition. The IRS hasn't really come out and said, this is how much you should be paying in your reasonable compensation. And a lot of times people try to make the reasonable compensation super low, because I did mention that our tax savings are maximized when our reasonable compensation is low. So sometimes people hear that and they say, okay, well, I'm just going to pay myself $1 a year. I'm paying myself a salary so that I can get my maximum tax savings. And I know that's not any of y'all amazing people on this webinar, but just in case you might hear somebody else say something like that, that doesn't work, okay? We want our compensation, again, to be low enough to, we want it to be low so that we can get the maximum tax savings, but we want it to be reasonable. If the IRS audits you and determines that your salary is too low, then they could recharacterize your distributions to wages and assess penalties and interest on the unpaid payroll taxes. So if you have $100,000 in profit again, and you said, well, I'm thinking my reasonable salary is going to be $100 for the year, and the IRS comes in and says, nope, not at all. We think that it's $60,000. Well, now you have $60,000 of income that now you have to pay the FICA tax on, that 15.3%. And because the IRS never catches this in real time, you're going to end up paying penalties for not paying it. And you're probably going to pay penalties for the next few years, or for a few years, because it could be a couple years before the IRS catches it. And not only that, they'll say, well, Lily did this year. She might have did that the year before, or Lily might have done that the year before. They might have done that the year before. And so let's go back and look at those other returns to see if they did that on their previous returns, and we might be able to catch them there too, right? So you want to make sure that it's high enough that the IRS doesn't raise any eyebrows, it passes a sniff test, and they don't go in and change some things, because then also, if they go in and do some recharacterization, their goal is to make money, right? The whole purpose of the Internal Revenue Service is to generate money for the government. So they're not going to come in and say, well, we think that your reasonable salary, we think it's going to be $30,000. They're going to come in and say, we think your reasonable salary should be $80,000. And then you're going to be stuck with that higher salary, which is going to cut into your tax savings. Okay. So we want to, again, we want to make sure that we are having our salary high enough to satisfy an IRS examiner, but low enough to maximize our savings. And Collective can help you. So again, we'll talk about what Collective offers towards the end of the webinar, but you guys are, in the right place to get all that information. So, but here's the problem with this. We know what reasonable compensation is. We know how important it is to get it right, but I'm going to go ahead and throw a wrench, because it wouldn't be a conversation about taxes if there wasn't an exception or, a wrench to be thrown. I mentioned earlier that reasonable compensation, is defined as the amount that would ordinarily be paid for services, for like services by like organizations in like circumstances. That was the definition that was provided on a couple of screens ago. But that sounds good, but what does that mean? No two businesses are exactly alike. So it's hard to determine, sometimes it's hard to determine what information you need to be able to figure out what reasonable compensation is, because that information is not readily available. you're not going to be able to look to my business and see how much I would pay because my information is not public, right? So there's no specific guidelines for reasonable compensation in the Internal Revenue Code or the regulations. So again, they've told us that you need to pay yourself a reasonable salary. They haven't given us a real like strict definition, or the definition is kind of like, well, still, what does that mean? And they don't give us any guidelines for how to calculate it. Various courts have ruled based on the facts and circumstances of each case. So again, your business might be similar to the next business, but you have different facts and circumstances. And so your reasonable compensation might be different than somebody else's reasonable compensation, even though they're very similar. A lot of people try to apply a formula, like a percentage of profits, and that does work, but you also still need to look at the facts and circumstances, because sometimes that even changes. The percentage that you're applying might even change because maybe your business has grown and you're not doing as much work in the business. So documentation is key to know that, to make sure that you are paying yourself reasonable, or the number that you come up with is considered reasonable. So documentation is key in business, period, especially when it comes to taxes and money and anything like that. But the more credible that documentation is, the more you're able to justify the number that you're using and defend the number that you're using if the IRS were to audit you and say, where did you get this number? Hey, Kesha, where did you get this number that $1 out of $100,000 in profit is reasonable? Well, Mr. IRS examiner, this is what I looked at, and this is how I determined that $1 is reasonable. And the more defensible it is, the less likely the IRS is to make an adjustment. And I'm not saying that they're not going to try to make adjustments, because y'all know the IRS, but if you have the documentation to back it up, you have a much stronger case. So now you're like, okay, well, you told me I have to pay myself a reasonable salary. You told me it's super important to get it right, but now you're telling me there's no way for us to even determine how we could calculate this. Like, what's going on here? Well, I didn't say there's no way. I just said there's no official way. So the IRS has provided a job aid that outlines 3 methods to calculate compensation. But there's a lot, like I said, different advisors may have different methodologies that they use, but we're going to talk about 2 of the 3 that the IRS has provided us to kind of look at when using this. So we're going to talk about the market approach and the cost approach. We're not going to talk about the income approach, just because that's more for bigger companies that are maybe more publicly traded companies that have information like that available. But market approach and cost approach, usually we can find information about those. So let's talk about what the market approach is. The market approach compares your business to other similar businesses and analyzes the wages or the compensation that's being paid to employees that are like you, like the CEO. So you're the owner of your business, you act in the manner of a CEO, then we're going to look at other businesses that are similar to yours and compare what you're doing to what they're doing and how much they're paying their salary, their people that are in the same boat. Notice I said similar businesses. I'm not going to compare you to Amazon, right? I'm not going to compare you to Walmart, because those are not similar businesses, and that's going to give you a way bigger number than you want. But we want to compare similar businesses. Courts really like this approach, but there's challenges in matching employees at comparable companies, because again, depending on the business, you might not have access to how much this compensation is being paid to this type of employee at that type of business. So here you may not necessarily go to a specific business, but you might be able to find some study that has aggregated this information based on business size and industry and things like that. So basically what the market approach is asking is how much compensation would be paid for this same position held by a non-owner in an arm's length employment relationship at a similar company. Arm's length employment relationship means that there's no relation, there's no kind of like sister, brother, mom, dad, type of thing. It's like somebody walked off the street and got this job. We don't know this. We didn't know this person beforehand, and we don't have any ties to them otherwise. So again, courts really like this, but it's difficult for smaller businesses to do this on their own unless you have some kind of like aggregate data that you can use. So here's an example of the market approach. And these are really big numbers just for example purposes, but basically you're going to take your information, and in this case, you're the taxpayer, so you're that on the fourth line, your business on the fourth line, and then you're going to compare it to 2 or 3 different comparable companies. You're going to compare a couple different data points. I've just truncated some information here. So you're going to say your total sales in this case are smaller than the total sales for all the other comparables. So you have a smaller business sales wise, follows that your profit is smaller as well. Your profit as a percentage of sales is smaller than the other businesses. So they're making more money, but they're also making more money in comparison to their sales. So they have a better cost management. Your return on assets is smaller, so they're actually able to generate more sales based on the assets that they use, but you do have a better return on equity. Now, for 3 out of the 4 or 4 out of the 5 examples that we looked here, your business was smaller, but your officer's compensation is higher. So this is when we would look at and we'd say, I would look at this as the advisor and I say, Cynthia, we got to do something different because your compensation is almost twice that of the next smallest business, and the next smallest business is way bigger than yours. So we need to make an adjustment. So this is kind of what we would look at with the market approach. Does that make sense for the market approach? Drop a 1 if that makes sense. Even kind of, sort of so. All right, awesome. I love seeing 1s. So let's talk about the cost approach. The cost approach is also called the many hats approach. So this one, while the market approach is good for like business owners who maybe have employees and they're more so managing the business and not necessarily doing a bunch of stuff in the business, the cost approach is good for business owners that don't have a lot of employees and are taking on multiple roles in the business, aka many hats, right? And I know a lot of us are familiar with that term. We wear so many different hats in the business. We are a photographer, and I use photographer a lot in these presentations just because that's what I use to come up with this presentation. But we're a photographer, but we also are a social media manager. We are a bookkeeper. We are a marketing our own marketing team. We are client acquisition. Like we do all the different things. We go out and buy our own, we're procurement. So we go out and buy our own equipment and things like that. So we are doing different things in the business. We're wearing many hats. So what the cost approach does is it breaks down your activities that you're doing in the business into the different components based on the time spent on that particular activity. And it calculates reasonable compensation based on the value of those activities. And you're probably like, okay, Kesha, what does that mean? Basically what it's saying, we're going to go back to what I just said. You're the photographer, you do the editing, you source the locations that you're going to shoot at, you do your social media marketing, you do your customer service, so you're answering emails and things like that. You're, going out and you're doing your own bookkeeping. So you have so many different things. So we're saying, how much time are you spending on bookkeeping? How much time are you spending on marketing, social media management? How many hours are you spending on finding the right location? How many hours are you spending on editing? And then we're going to take how much would you pay somebody to do those different things? If you were to get a bookkeeper, how much would you pay them to do that for that many hours? How much would you pay somebody to do the editing for that many hours? And then we add it all together. That's going to be your reasonable compensation. So here's an example. This is super simplified. Again, photographers on the call, don't look at this and be like, what is she talking about? I know I don't have any idea what I'm talking about when it comes to this. This is just an example. So we're going to say that in your photography business, you spend 250 hours actually shooting. You spend $250 250 hours actually shooting photos, right? And then you also spend another 250 hours editing those photos. Then you spend 750 hours doing your social media management. You spend another 750 hours customer service, answering phone calls and things like that. We're going to assign an hourly wage. Again, I don't know what these numbers truly are. I just threw some numbers on here, but we're going to assign an hourly wage to each of those components, multiply across, and then add down. So if we're going based strictly on these 4 things, which you only have to do this up to 2,000 hours a year, even though I know that we're spending more than 2,000 hours a year in our businesses, the IRS only requires you to do this. You only have to do this on 2,000 hours a year, which is the full equivalent of a full-time job. So if you spent 2,000 hours doing these 4 activities at this, reasonable wage or average wage per hour, then your reasonable compensation would be $24,500 for the year, but your profit is $100,000. So if you were to make $100,000 in your business, and we're going to say our reasonable compensation is $24,500, then you only have to pay FICA. Remember, going back to our other slide, you only have to pay that 15.3% on the $24,500. You can take the other $75,500 out of the business without paying any additional tax. You still have to pay income tax, but you don't have to pay the self-employment tax that you would have to pay if you were not an S corporation. Does that make sense? Drop a 1 if that makes sense. Awesome. I see the ones rolling in. Awesome. Awesome. So a question that I get asked is, okay, so here's the cost approach, here's the market approach. Which one is best for a business of one? Okay, somebody asked me to quickly repeat this. So I'm going to go back over this one more time. So if your business profited 100, actually, I'm going to say this one more time, but I actually do have a screen coming up that's going to show all the numbers. But if your business profited $100,000 and your reasonable compensation is $24,000 as an S corporation, then you only have to pay FICA on the $24,000. But you can take the whole $100,000 out of your business. You only have to pay FICA on $24,000. If you were a sole proprietor without having the S corporation, you'd pay self-employment tax, which is again the equivalent of FICA, on the whole $100,000. So the tax savings comes in is you don't have to pay that FICA on that $75,000. So again, I get a question a lot about which one is best for a business of one. Is it the cost approach, the market approach? Which one should I use? Again, these are job aids this is from a job aid that the IRS provided. It's not all inclusive of all the different ways that you could actually come up with this. But if we're going to talk specifically about these 2, then I would say that it's going to depend on your business. So the cost approach, again, I think works best for businesses where the owner wears a lot of hats, and specifically, they're doing a lot of jobs that could be low wage. So you're doing a lot of jobs that you would not necessarily pay somebody a whole lot of money for, because that's going to reduce your reasonable comp. Whereas the market approach, I think, will work best for businesses where the owner has a lot of employees that are handling the day-to-day, and the owner really works mostly on the managerial tasks. Neither one of these could work. It just really depends on your business and, the advisor that you use. Now, Collective uses the proprietary methodology that they use to determine what your reasonable compensation is. So again, this really could depend. It could vary greatly from one business, from one advisor to the next advisor, one business to the next. So now I mentioned that I have an example that's going to walk through the savings and the numbers and everything. So let's go ahead and get into that. This is the part I really love because I'm a math nerd. So we're going to add some real numbers to everything that I just talked about. So we're going to go back to our assumption that you have business profits of still $100,000. It says $75,500 here because this is after the reasonable compensation, because that does reduce your profit. When you have a S corporation, your regular profit is $100,000, you pay yourself a salary, you get to deduct that from your business, right? So your reasonable compensation reduces your taxable, your business profit. So you have business profits of $75,500, reasonable compensation of $24,500. That gets us back to the $100,000. your personal income tax rate is still 22%. That's all you have. You don't have any other income. If you were a sole proprietor or a single member LLC, your income tax would be about $9,964. Your self-employment tax, remember the 15%, $14,129. So your total tax, $24,402. So on $100,000 of profit in a sole proprietorship, you're going to be paying about $24,402 if this was your exact tax situation. The only difference that we have here is that we have created an S corporation for our business and paid ourselves a salary of $24,500, and that drops our total tax liability from $24,402 down to $15,165. That's a total tax savings of $9,237. Now, some of y'all might be looking at the actual numbers and you're like, but wait, Kesha, the income tax went up. It did, because when you're a sole proprietor, you actually get an additional deduction for part of your self-employment tax that you don't necessarily get on your S corporation. You do, but it's kind of convoluted. But the big picture here is that your whole total tax savings did go down. Some stuff went up, some stuff went down. Overall, it dropped a lot. Okay. So drop a 2 in the comment if you could do a lot of money, if you could do a lot with an additional $9,000 a year. Me too, right? Me too. And the best thing about tax planning when you're doing things like this is that this is not a one-time tax savings. This is a year-over-year tax savings, but you can also build tax planning opportunities onto each other. So in addition to S Corporation, we're going to talk a little bit about some other some other planning opportunities that you might be able to take advantage of with your business. So the first thing that we want to talk about is tax-free benefits, or really the big thing that I want to talk about is tax-free benefits. So where your reasonable compensation is going to include tax-free benefits such as retirement plans. So if you are paying yourself a salary of $24,500, that doesn't all have to be cash. That could be partly tax-free fringe benefits, which is going to reduce your overall taxable income because it's money that you don't have to pay tax on right now. And in some cases, it's the money that you might not have to pay tax on at all, depending on what you put it in. So we're gonna, I definitely want to point out where it says at the bottom, please consult an advisor before you set up any benefit plans. Do not do this on your own. Don't go out and say, well, Kesha said I should. I did not say that. What I said was consult an advisor first, okay? But I want to talk about how retirement savings can, I want to talk about how your retirement savings can actually save you some, or excuse me, putting money into retirement can save you some money on your taxes. So we're going to assume the same facts from the previous example. So $100,000 in profit, less the salary of $24,500. Of that $24,500, you're putting $19,500 into a retirement plan contribution, a retirement plan for your future. So really, you're only giving yourself cash of $5,000. Okay, so taking the $24,500, putting $19,500 into a retirement plan. Without the retirement plan, your total tax is $15,165, as we showed on the previous slide. With the retirement plan, that drops your total tax liability down to $11,194. So putting that $19,000 into a retirement account is going to drop your current year tax savings another almost $4,000. Now, this is a tax deferred thing, so you're still going to end up paying tax later on during, when you pull the money out. But as of right now, you're able to save another $4,000 almost. But still, there's even more. Now you're able to also match what you put into a retirement account. So just like if you had a W-2 job where your employer had a retirement account, a 401k, and you put money into it and they matched up to a certain amount, you can match for yours. You're the employer in this situation, so you can match your employee, also yourself, contribution to a retirement plan. So you're going to match, in this example, $6,000 for the $19,000 that you put in. So without the match, we just said on the last screen that your total tax would be $11,194. With the match, your tax liability will be $10,116. That's an additional tax savings of $1,078. Now, some people might look at this and be like, okay, you started with some real big numbers. Now it's $1,000. Like, yeah, it's not really a big deal. But so, going from, not matching to matching might not be a big deal. But when we look at where we started to where we ended up, we went from total tax liability of $24,402 to a total tax liability of $10,116, all from setting up an S corporation, setting up a retirement account, and matching into the retirement account. Those are three fairly simple tax strategies. The Internal Revenue Code is full of these things, okay? And you have access to them just, like the Amazons of the world do. So you have access to things like this that can help you reduce your tax liability. So again, now we talked about earlier, I said drop a 2 if you could use $9,000 a year, drop a 3 if you could use $14,000 a year, right? And like I said, this is a year, so this is an annual tax savings, because saving the money into switching over to an S corporation and putting money into a retirement, as long as you're doing this every year, you're going to get the same tax savings. Now, it might not be exactly the same number, but you're going to get a tax savings every year. There are some things that, are one-offs type of things, but these strategies will save you money every year. So I saw a lot of 3s. I'm with y'all. If I could save me $14,000, another $14,000 on my own taxes, I'm gonna try to find it, because that's a lot of money that you can do a lot with. You can put it back into your business, or you can use that money to fulfill your why. So, you might be in business so that you can, spend more time with your family, or put money aside for your children's college education, or give back to your community. Or if you're like me, single with no kids, be able to spoil your nieces and nephews so you can send them home. But that's a lot of money to be able to fulfill the dreams and goals that you have for yourself. And this is why I love doing what I do, because I'm able to use the tax code, which is something that a lot of people, really kind of cringe up at, to be able to help people fulfill their goals. So I did a lot of talking, and now that I have talked you guys to death, I just have one question. And that is, are you thinking about switching to an S corporation? You should see something pop up on your screen, a poll, where it's going to ask you. I think you're going to see something pop up on the screen. If not, drop a yes in the comments, or no. Just let me know what you think. If you don't see it pop up on your screen. Awesome, a lot of yeses. Okay. All right, I think it just popped up. So go ahead and answer in there. In the pop-up the polling question that just popped up. We're going to give it a couple seconds so we can get to you guys' questions. And if you're not sure just yet, because I see a couple people saying they don't know, then that's fine. At the end of this presentation, you'll get you'll be able to reach out to a advisor with Collective that you can talk to, and you can ask them more in-depth questions about your business. They can let you know if it's right for you, or where, when it would be right for you to switch. So for all the not sures, just make sure you set up that appointment and call in so that you can talk to an advisor specifically. So just recapping what we talked about in the beginning, when you're a sole proprietor or you're a self-employed individual, business of one, you have so many things that you have to do in your business, in the back office, that's completely not on your mind when you're setting up. When you decide that you want to, sell t-shirts, you're not thinking about getting an EIN, figuring out how to set up a payroll account so you can pay your payroll taxes, and, calculating what your reasonable compensation is, or doing your bookkeeping. Y'all might, because y'all seem very in tune with your business, but I've seen a lot of people that's not thinking about that type of stuff. So with Collective, again, all of that stuff comes in one back office that you have access to, and it makes it a lot easier to be able to manage all of those things that you might be a little bit confused about because you're not thinking about that. Here on the screen, sole proprietors, single member LLCs, LLCs that are filing as S corporations, real estate professionals in certain states and not all the states. And then on the side, if you are already a C corporation, if you have a LLC with more than one member, certain professional licenses, and under $60,000 in profit, at this time, Collective is not accepting these kind of clients. But again, stay tuned because something might change down the road. When you do decide to work with Collective, this is what you can expect in your first year. So you can expect for them to help you with your S Corp formation. That includes all of these steps. You can expect them to help you set up your bookkeeping, run your profit and loss, teach you how to read it and analyze it, run your first payroll, set up payroll, train you on the bookkeeping. You can expect for them to help you with your monthly bookkeeping and financial support. They're going to categorize the transactions. They're going to give you an expert review of your financial statements. They're going to give you a package of your monthly financial reports. You have a team of finance experts that you can message when you have questions or advice. And then, of course, they're going to help you with your taxes. So they're going to help you calculate what your estimated tax liability should be and how much you should be paying every quarter. They're going to help you with filing your business returns and your personal returns for both the federal and the state every year.